Welcome to episode 17 of the Visionary Investor podcast. There's been some shifts and I'm very excited to introduce this new section of the podcast where I'll be expanding on advanced strategies in investing in the stock market to not only build and grow, but also protect your wealth. I'm very passionate about this because it's really been the backbone of the research that I've done and experiences I've had building out my own recession warning indicator model, investing myself, and using these strategies that a lot of top level and billionaire investors use that are not so often spoken about in traditional investing and in mainstream media either. I can't wait to get you guys involved learning and expanding your knowledge base in these areas so that I can help you as well. So what I'm going to be sharing in this new section of the podcast also expands off of many advanced models and methods used by professionals. You're going to acquire the right knowledge to be able to target 15 to 20% plus annualized returns. We're going to have some great discussions on some of the following topics: how to protect your wealth, including mastering the markets, whether it's a bull or bear, wealth investment personalized to you, diversified stock portfolios, different investment categories and funds, so small caps versus large caps, mutual funds, bonds, index funds, ETFs, and how those all play into helping you or hurting you when you're trying to protect your wealth. The portfolio management piece, which is a huge piece of it, regarding asset allocation, asset selection, diversification. One of my favorites is investing statistics, reducing volatility, checking on your monthly return distributions, looking at stock sectors and correlations, really getting a better understanding of the overall history of stock returns and how that aligns with your goals. Everything falls back and goes to your goals. Economics, understanding these landscapes, the recessions, history, really helps give you an advantage in the stock market compared to those who aren't aware and can't predict or see those patterns. Questions to ask your trusted financial professionals. This is so important because a lot of people that I talk to, a lot of investors, they haven't even looked at their financial statements, or if they have, they're not really sure fully what certain things mean. Sometimes they ask, other times they don't, but there are certain key questions you're gonna wanna ask your trusted financial advisor, and by doing that, you will have more of a lead role in your own ability to protect your wealth. Understanding the fundamentals of the companies you're investing in, such as leveraging your industry expertise for competitive advantages. Use the knowledge that you know to give yourself an advantage in the stock market. And lastly, a long-term strategy. So we're gonna help you build an investing roadmap and automate the investing process so it's not a grueling and difficult task, but rather something that you enjoy, doesn't require a ton of work on your effort aside from initial research or working with your advisor to help complement research that's done, because you want to be really confident in your investments and you want to know that you're truly protecting your wealth, not just coasting. As well, we're going to be bringing in some guests that can add to these conversations. There's really a large difference between investing because someone has told you that this is a great investment, whether it's the financial media or whether it's a trusted advisor. There's really a big difference between investing based on someone else's opinion and your own. Because at the end of the day, even though advisors are there to help you, you really want to be able to be the driving force behind your portfolio. And when you're investing into hundreds of different companies through mutual funds, index funds, and you don't actually have a strong asset allocation, you just have many different investments, you're actually putting yourself at a disadvantage. And that's why I talk so much about just finding 3 to 7 really strong stocks in different sectors that can work well together and help offset difficult times. And by understanding recessions and economic downturns and different patterns that we've seen across past history, you give yourself an advantage because you're able to take that information and use that to determine if the assets you're investing in are actually protecting your wealth or just kind of keeping you riding the coast. To really be amplifying your impact and creating generational legacies, you really want to be targeting 15 to 20% plus annualized returns. A lot of investments are really only targeting 10, 12%. They're trying to beat the market or they're trying to beat a benchmark. and a lot of them are failing. If you find strong assets and stick to them, and you create a plan because you understand cycles of the economy and how that impacts the investments that you have, you will have such a more successful time investing in the stock market and protecting your wealth. It all comes back to protecting your wealth. The better you are at choosing strong investments and creating a strong asset allocation because you have the knowledge and understanding, the better investor you'll be, the greater success and easier life you'll have. One of the areas that I'm really just so passionate about, and I'm looking at some data right here in front of me, is 5-year monthly return distributions. When we're looking at different stocks in a portfolio, whether it's 2% of the portfolio, 20%, 30%, you want to understand how that stock is impacting your returns. And the big thing that I notice is a lot of times we just see that the company has performed very well over the long term and forget about those huge downward slides that happen throughout the years. And the less normal distribution returns have, and we'll get really granular into this in a later episode, but I just wanted to share a little bit about it. What happens is we start having these drastic price swings. And sometimes they're more drastic on the negative, sometimes it's balanced. But when we're seeing companies that are down 20%, 30% in a month and even more, that's a lot of risk. To me, I don't want to see that because that's a ton of volatility. Even if the company ends up being up 100% for the year, you still had to go through these immense downfalls. And when you're investing millions and billions of dollars, that is a big, big shift to your portfolio. So by creating that stock portfolio with 3 to 7 strong companies, not companies that are going to have these incredible price swings, you're looking more towards companies like Microsoft and Apple and looking at their return distributions completely different than Nvidia and especially than a company like Tesla. So it's finding strong assets that their fundamentals are incredibly strong, the leadership team is incredibly strong, and then when you look at the risk-adjusted return of these companies, you understand and you can see why they performed well with low levels of risk. Pair that with other companies that have low correlations working well together, you have yourself an amazing stock portfolio that'll help you target those 15 to 20% plus annualized returns. Thank you so much for listening. I can't wait to get started. Make sure you subscribe, like the podcast, and listen wherever you get your podcasts.